Hi, I'm Reid Baker, Vice President of Analytics and Data at Fundata, and I'm going to give you an overview of Fundata's Canadian Alternative Investment Fund risk ratings. The Fundata risk ratings are based on 4 risk measures that met the criteria for wide market acceptance and breadth of data: maximum drawdown, standard deviation, up-down capture, and batting average. For each of the metrics, scores are assigned for 1, 3, 5, and 10-year periods. Then we take the average score across the time periods to arrive at a final score from 1 to 5. We also add a liquidity score that was developed in partnership with Sigma Sandbox. To be consistent with regulatory requirements for retail funds, we use 10 years of performance history for each fund. Funds that don't have 10 years of history are supplemented with proxy index data based on the investment strategy of the fund and how it fits into one of 6 categories. Let's look at the detail of how each metric is calculated. Maximum drawdown measures a fund's peak to trough loss over a specified period. We calculate the max drawdown for each fund and assign scores based on how it compares to the drawdowns of the 6 hedge fund indices. Standard deviation is a widely accepted measure of volatility risk. It's calculated over each period using monthly returns and then slotted into one of 5 volatility bands. These are the same volatility bands that are used for calculating the FundFacts risk ratings for mutual funds and ETFs. Up and down capture measure how well a fund did when the market was up and down respectively. Up capture greater than 1 represents outperformance, and down capture greater than 1 represents underperformance. This is an illustrative grid showing the universe of funds over a 5-year period, where the black lines represent the medians. Scores are given dependent on which quadrant the fund falls into, as seen in this table. The scores from 1 to 4 are converted to a 5-point scale. Batting average measures how often a fund produces a positive monthly return. Scores are given according to how the batting average fits into one of 4 quartiles. The scores from 1 to 4 are then converted to a 5-point scale. Finally, the liquidity score considers 5 liquidity measures related to how a fund can be bought and sold: redemption frequency, redemption notice, early redemption cost, suspension, and gating. For each measure, funds are given a score from 1 to 5, where 1 represents higher liquidity. The 5 metrics are combined using a weighted average based on relevance. The results are converted to a liquidity score from 0 to 1. The final risk rating is determined by taking the average score from the 4 risk measures and adding the liquidity score. The highest score a fund can get is 5. For more information, please visit our website or reach out to one of our team members.
Welcome everyone, and thank you for joining us at the 7th Annual Canadian Hedge Fund Award Winners Showcase. Ordinarily, we hold this investor conference at the prestigious Albany Club in downtown Toronto, but of course, these are not ordinary times. We've shifted gears a couple of times in the preparation, and we're pretty excited about sharing this virtual event with you. It will be different, to be sure, but we know you'll be glad you joined us. As all of us consider how to invest in these unusual times, how best to achieve our investment objectives. It seems there are more questions than answers. This afternoon, you will get many of those answers from an impressive group of 5 award-winning Canadian hedge fund managers. I'm Julie Makepeace, and I will be your MC for this investor conference. It's an honor to be with you this afternoon. If you haven't already, please go ahead and download the event brochure. It's in PDF format on the page where you logged in. Before we proceed, I really want to thank our sponsors, Fundata, National Bank, and Scotiabank, and our media partner Newsfile. Without their generous support, this investor conference would not be possible. Certain hedge fund strategies can replace some or all of an allocation to traditional long-only equity or credit investments, and ought to reduce the overall volatility, reduce the risk of the portfolio's public markets allocation with a more attractive risk-reward profile. Other hedge fund strategies may have a low correlation to equity and credit markets and offer a higher probability of generating outsized returns, albeit by taking on a higher level of risk. In our conference today, we will hear from 5 award-winning Canadian hedge fund managers. Noah Blackstein, Vice President and Senior Portfolio Manager, Dynamic Funds. James Cole, Senior Vice President and Portfolio Manager, Portland Investment Council. Sandy Liang, Portfolio Manager, Purpose Investments. Jim McGovern, Managing Director and CEO, Arrow Capital Management. And Paul Sandu, President and CEO, Merit Asset Management. These managers represent 2 equity-focused, 2 credit-focused, and 1 global macro fund, and they will address the key issues on your minds as you consider allocating to these hedge funds as replacements for and/or complements to other investments in your portfolio. And to help us look under the hood of these award-winning funds, we have a panel of investment experts with us this afternoon. Loren Francis, Vice President and Principal at Highview Financial, and Craig Michelle, Director and Portfolio Manager at Richardson GMP. Each hedge fund manager will make a brief presentation and then face our panelists for Q&A in a sort of kinder, gentler Dragon's Den format. A very special thank you to Craig and Loren, our Investors Inquiry panelists, for making the time to prepare for and to participate in our Winners Showcase 2021 Investor Conference. And now, on with the show. Our first presenter this afternoon is Noah Blackstein, Vice President and Senior Portfolio Manager at Dynamic Funds. Noah has managed the Dynamic Power American Growth Fund for more than 22 years, the Dynamic Power Global Growth Class for 20 years, and the Dynamic Alpha Performance Hedge Fund for more than 18 years. His assets under management have grown to more than $10 billion. Throughout his 25-year career, Noah has won numerous industry awards, including several in 2020, and has appeared in well-known publications, including Barron's and the Wall Street Journal. And as you know, he's also a regular guest on CNBC. Noah has managed the Dynamic Global Growth Opportunities Fund since its inception in March of 2015. The fund experienced another strong year in 2020 with a calendar year return of 53.8%. The fund was ranked in first place for both its 3- and 5-year returns at the 2020 Canadian Hedge Fund Awards. Noah, thank you so much for joining us today. Before we invite Craig and Loren on screen, I'd like to pose the first question, if you don't mind. I'm wondering what prompted you to start the Dynamic Global Growth Opportunities Fund in the first place? What was your objective with the fund?
Well, to be honest with you, I run quite a few assets in both Power American and Power Global, as well as an alternative strategy and alpha performance. So, what the situation that presented itself was that there was a couple of old hedge funds at Dynamic that had basically shrunk down to about 30 million in assets, roughly. And then the opportunity arose to be able to take those assets and launch another strategy. I wasn't interested in it initially, but I thought that there'd be a few things that we could do in that strategy that we can't do in our other funds, including involvement in convertibles, involvement in things such as privates if they presented themselves. Plus, it was a smaller asset base, which allowed me to go down capitalization curve. But I think what first intrigued me was the fact that this was about a $30 million fund 5 years ago with several $100 million of tax loss carry forwards, and the ability to not only exploit our strategy a little bit down the curve in a little bit of a unique way, plus the ability to use several $100 million of tax loss carry forwards and not have to pay out capital gains distributions. For me, was very exciting. And as of December of 2020, we still have about 174 million of tax loss carry forwards in that fund. So there's not a lot of tax breaks these days, but this presented that opportunity to be able to implement the discipline and process that we have, but also to do it in a very tax efficient way.
I really appreciate that. Thank you. I'd like to invite our panelists, Loren Francis and Craig Michelle, to join us. I think they're coming on screen now. Our investors inquiry panelists for the Q&A segment. Loren, perhaps you'd like to lead off, and I will leave you.
Great. Hi, Noah. The first quarter in 2020 certainly saw some extreme market moves. We all witnessed that. We witnessed some more market moves towards the end, just going into the fourth quarter as well. How did you manage through those periods, particularly the first quarter of 2020? And were there moves in these periods that you've seen before in your career?
Well, I've been doing this for a long time. I started at Dynamic in '97, but I was at a different firm called BPI Funds before that, where I started in the early 1990s. And so, I came in right around the Mexican peso crisis, and I saw the Russian debt default and long-term capital, managed through 2000, 2002, and obviously the global financial crisis as well. So I've seen worse bear markets for sure. I've never seen anything as fast as what we went through in February and March of 2020. Typically and historically, when we go into these bear markets, usually coming toward the end of a tightening cycle by a central bank. And so, they've obviously raised rates way too far and way too high. And then you get this obviously big economic slowdown, and then the areas of excess investment are usually ones that take it on the chin, whether that was in technology in 2000 or whether that was in housing in 2007 and 2008. This was a little bit different. There were no real major excesses in the overall economy. Things were going on, and then this sort of pandemic hit. So to the extent, we really didn't change very much in terms of what we did. So a lot of the areas that we're focused in on that demonstrate secular growth that were growing before this pandemic, obviously are an area of focus even coming through and out of this pandemic, whether that's digital transformation of enterprises or digital transformation in healthcare, the move to e-commerce or other things like that. A number of the areas that we've been focused in on have been beneficiaries, as strange as that term may sound, from the pandemic. So, if the pandemic really did anything, it sort of obviously paused everybody's lives in the present, but it really did accelerate the future. The question is, did it bring forward the future? And I think it likely widened and lengthened the runway as opposed to pulled forward demand from the future. So we didn't make any great changes. We weren't really in any of the impacted businesses in travel or in leisure or in any spaces like that. So overall, staying the course is what obviously served us best during that big break in February and March.
Great. Well, given your history of investing in technology over the last 20 years and, how technology is continuing to accelerate innovation and disruption, do you see other areas, I mean, you mentioned a couple, but do you see other areas as being susceptible to significant change and the ability to take opportunity?
Yeah, I think so. I think, look, when I started in the business, the technology was really a product. It was a piece of hardware on your desktop. It was all about the personal computer in the late 80s and early 1990s, and it was all about the software. And then it became about networking those computers within your business, and then it became, obviously the move toward the internet and other things. But for the most part, in the early part of my career, technology was a piece of plastic and metal on your desk. I think post the bubble of 2000, 2002, where we had all this massive fiber optic cable with when Web 2.0 came out, that overinvestment provided an enormous opportunity for a lot of companies in the aftermath. If you think about it, companies like Netflix or Amazon Web Services or other companies like that really wouldn't have emerged into the huge, in some cases, trillion-dollar businesses if it wasn't for that overinvestment. But technology today is much more of a platform than it is a product. So if you're in financial services, you're talking about fintech companies, you're talking about digital wallets, you're talking about how to engage, you're talking about internet banking, you're talking about things like Robinhood and other online platforms. If you're in healthcare, you're talking about digital medical records, you're talking about telehealth, you're talking about remote patient monitoring. If you're talking about entertainment, you're talking about over-the-top delivery, you're talking about Netflix or Disney Plus or things like that. And so, technology is no longer a product. It's the platform for basically everything that we do. I had a recent conversation with the CEO and said, look, we're still going to eat, we're still going to watch movies, we're still going to buy clothes. The question is, how do we do those things? And that's really what's changed and what's different today than probably 20 or 30 years ago, where it was just all about putting a productivity device on your desk. This has now become the platform to engage, to sell product, to get customers. So we're in a very different situation. And if I look at it across the board, I think that there's still going to be opportunities out there. I think there's a number of industries in the early stages of this revolution, and whether that's in healthcare or in finance, especially in finance. We're seeing it especially in emerging markets where banking services have been limited for a number of reasons. And what you're really seeing is the emergence of internet-only banks in many of these emerging markets that are really garnering a tremendous amount of share. So, whether that's in finance or in healthcare, there are industries that are a little bit further back, but there are industries that are probably much earlier on in this digital transformation, and the opportunities are quite enormous when you look at the market sizes.
Okay, can I jump in there? You're contrasting today's technology with from 20 years back, which is quite interesting. Can you talk to that in the context of valuations? You'll talk about this, but certainly back in the late 1990s, early 2000s, there were a lot of companies which just weren't companies. They were tickers on a stock exchange. They weren't real companies. Today, I think that's fundamentally different. But can you talk us through where we are in valuations as a contrast and/or forward?
So the way we frame valuations is we're really trying to figure out, what does this company look like in 3 to 5 years? What do the revenues look like? What do the earnings look like? How much can this company earn? So I'll give you an example. When Google went public in 2005, 2006, I think the analyst estimates were around forward earnings were around $3.75 for the company. This was pre-split, I think. And $3.75, and the stock was coming public around $100 a share, roughly. They were doing just under $2 billion a year in revenue, And so the question was, what was the opportunity for Google?
Right.
And that was sort of how we looked at it. And if you looked at $600 billion a year spent on advertising with less than 2% of that online, and you said even if 10% goes online, search is half of that, and Google has 50% market share of search, then this is you can sort of get your way to kind of between 10 and 20 billion of revenue. So you could see the path for them going just under 2 billion of revenue to close to 20 billion of revenue. And then you figure out sort of what the margins are. And that was true in 2013, stumbling out of the IPO. A similar situation with Facebook. I think you could sort of look 5 years forward in 2013 and kind of come to somewhere around $8 to $9 of earnings power, which is sort of where they were. And so how we frame valuation is looking forward as growth managers fundamentally. And we're trying to figure out, well, what does this look like? And look, there have been numerous examples over the years where we've looked at a company or we've owned a company. I think back to 2002 to probably 2006-ish, where we had a company like Whole Foods Markets, which, we did all the work on it, thought, X numbers of stores at 45 or 50,000 square feet, X dollars of sales per square foot, and then what could this company probably earn over the next 3 to 5 years? And then looked at where the stock was trading and really came to the conclusion, well, companies really, everything has to go right just to sort of justify where it's trading. So, we look at what the opportunity is. We frame value. If we're right on a stock, in hindsight, it looked like a value stock. We picked up Google probably at around 4 times earnings. Similar with Facebook, was probably trading at close to 1.5 times 5-year forward earnings. And so that's how we look at things, and that's how the type of valuation that we do. There are certainly overvalued companies out there today. But similarly, I saw a whole bunch of companies that were trading at 9 and 10 times earnings in 2005. Whether it was Citigroups and whether Lehman Brothers and Bear Stearns that traded at single-digit earnings multiples, some of which even disappeared and went to zero. So, whether it was trading at 10 times earnings or 10 times sales, the most important variable was figuring out the future and what the company looked like in the future. And so, we do that for all the companies that we own. And if we can't get past the stock price relative to the current earnings, then we're going to, or to the future earnings, then we're going to move on from the position. Sure.
Okay, good.
Noah, and Craig and Loren, unfortunately, our time with Noah is up this afternoon already. I can't believe it. But I do want to ask the two of you, Loren and Craig, a question to wrap up our time with Noah. And that question is, to which type of client would you recommend the Dynamic Global Growth Opportunities Fund, and how would you use it in the client's portfolios?
Great. Well, I think it would be very much for a growth-oriented investor. We'd use it in particularly within our alternatives segment of our portfolios. And as you know, I think many family offices and many investment advisors are growing the alternatives part of their book substantially. We've gone from 10% to 25% of our client portfolios in alternatives. So it's certainly an interesting fund to be looking at for that growth-minded investor.
Yeah, I would agree with all that. Certainly goes into the growth bucket. And I think with a long-term view, you'd want to encourage your clients to have a long-term view. Looking down at your feet, some of these things can get a bit painful at times, whether it's in March or, whenever the next sort of shoe drops. But I know he's got a fantastic track record. He's proven himself for 20 years. And this is a non-correlated view to upside, likely above index performance. And it's not replicable. Typically as investment advisors, we can't buy these stocks. Actually, hang on, let me back that up. We can buy them. It's very difficult to sell them, right? That's where we get all tripped up. So rely on Noah to get that part of the job done and look down the track for bigger returns.
Great. Well, thanks to all of you. Noah, thank you so much for being with us today. We really appreciate it. And Craig and Loren for helping us look under the hood of this Dynamic Global Growth Opportunities Fund. Thank you so much.
Thanks, Noah. Thanks, Julie.
Thank you.
Thank you.
Next to present today is James Cole. Senior Vice President and Portfolio Manager, Portland Investment Council, and manager of the award-winning Portland Focused Plus Fund. The fund was a winner in the Equity Focus category at the 2020 CHFAs for its 5-year return. James joined Portland Investment Council, at the time it was AIC Limited, in February 2000. Mr. Cole has 37 years of investment experience, including 28 years as a portfolio manager responsible for Canadian and U.S. equities. In addition to the Canadian Hedge Fund Awards, investment funds managed by James have received PCMA and Lipper Awards. I'll turn it over to James now, who will make a brief presentation and then bring back Craig and Loren for Q&A. James?
Thank you, Julie, and thank you to the viewers for attending this virtual event. I'm going to present 2 funds of which I'm the portfolio manager and in which I'm a major investor. The first is the award-winning Portland Focus Plus Fund LP. The LP, as I'll call it, is intended for non-registered assets. The LP also has what is essentially a sister clone fund, the Portland Focus Plus Fund. It's intended for investment by registered plans. I'll refer to it as the trust, since that's its legal form. The investment strategy employed in the funds is very simple. We buy good businesses, we add to them when they're attractively valued, and reduce them or sell them outright when they're more expensive. And we repeat this process over and over, or as the slide says, repeat until rich. The next slide takes a deeper dive into the fund's investment style. First, the funds are very focused. I'm quite prepared to have individual company weights of 40% or more of net assets. That's important because that's how wealth is created, owning a focused portfolio of high-quality businesses in large percentage weights. The funds also employ active leverage management. That has been key to the long-term success of the funds. The use of leverage is why the funds have plus in their name. It's because they're able to use it to enhance their returns. I'll have more to say about that in a moment. We only invest in large cap proven businesses, so market caps of $10 billion and up. That's important because it means that our investment process is repeatable and scalable. And the funds have delivered compound annual returns since their inceptions of about 20% or more, depending on the fund and the series. Drilling down even deeper into the details, as I mentioned earlier, the LP is for non-registered assets and the trust is for registered assets. So between the two of them, they cover the waterfront of investor needs. The funds may only be purchased by accredited investors or through advisors who are registered as portfolio managers. The funds are valued monthly at every month end. And another key differentiator is that I and other members of my family are major investors in the funds. So as the saying goes, I've got skin in the game. That means that my interests are fully aligned with yours and your clients. The investment process that we use is the proprietary float system. We focus the funds in a small number of companies in large percentage weights. We enhance returns through the use of leverage. We optimize the portfolio continually, adding to weights in businesses with high expected rates of return, while pruning or selling outright businesses with lesser return prospects. We focus on after-tax returns, which I think is a major difference compared to other funds, and we give the process time to work. These funds are all about harnessing the incredible power of compound interest. That's why in just over 8 years since inception, the LP's Series M units have sextupled in value. This is a graphical illustration of what we do when that I think everyone can relate to, the seesaw or teeter-totter. When stocks are low, we add to equities using leverage. Conversely, when stocks are high, we reduce equities and take the leverage down or eliminate it altogether. It really is that simple. This next slide shows the LP's equity weight. The jagged line shows the LP's total equities divided by its net assets for every month end since the LP was first invested 8 years ago. The horizontal line shows that the average has been 150% invested. Anything over 100% is financed with margin borrowings. The use of a variable discretionary amount of leverage has certainly been an important factor in driving the LP's strong performance. Here you can see the teeter-totter in action. For example, in December of 2018, at the market low, we took the LP's equity weight up to a record high. By January of 2020, with stocks at record highs, we took the LP's equity weight down to a record low. By October of 2020, with recovery stocks at low valuations, we took the LP's equity weight way up to 210%. And with the very strong returns since then, we've taken the equity weight way down to the current level of about 130%. Speaking again of performance, this slide shows the LP's rolling compound 5-year return. For the 3 years that it's had a 5-year return, it's ranged between about 10% and about 25%, and most of the time it's been in the range of 15 to 20% per annum. So anyone who's been invested in the LP for at least 5 years has enjoyed a very positive experience. This next slide shows the cumulative performance of the LP's 4 series since inception, the lines at the top, versus both the MSCI USA index in US dollars in about the middle of the graph, and the MSCI Canada index, that ugly line at the bottom. The LP has vastly outperformed both the MSCI USA index and MSCI Canada indices. Here you can also see that sextupling of the Series M units that I referred to earlier. This next slide shows the performance of the trust since its inception in March of 2016. It's been a much shorter period, but a similar story as for the LP. This next slide shows that despite the fund's focused investing, they have a lot of diversification, which is important for risk management. For example, at the end of 2020, the funds held 10 businesses in 4 major industry sectors across 5 of the world's major geographic regions. This next slide has a lot of numbers, so please allow me to explain. What this table shows is that if the LP had just one investor who was a resident of Ontario in the highest tax bracket, the tax rate that he or she would have paid on the LP's allocations would have been only 24.2%, or less than half of the rate applicable to ordinary income. How can that be? It's because most of the LP's income is tax advantaged, dividends and capital gains, while all its expenses are fully deductible from income. So the LP is very tax efficient for non-registered assets, while the trust is an excellent vehicle for long-term tax-deferred or tax-free compounding of registered assets. The final slide is a disclaimer, which says in part that past performance may not be repeated. Thank you very much for this opportunity to present the Portland Focus Plus Funds. Panelists, I'd be happy to take your questions.
Thank you so much. That was really interesting, James. We really appreciate it. And I see that Loren and Craig have joined us. Excuse me, Loren, perhaps you could lead off with the first question.
Sure. James, perhaps you could tell us how you actually look at various companies and how you value them, and given where interest rates are today, how that plays into discounted cash flow models and what it is you're trying to achieve, given that you are sort of very concentrated.
The primary valuation methodology is a discounted cash flow approach. And today's interest rates pose a challenge in doing that, because if you use interest rates of 1 or 2%, every stock looks, cheap. So I do what I gather that Warren Buffett of Berkshire Hathaway, our role model, does. When interest rates get very cheap, I just use a floor of 8%. I say that's kind of the long-term rate of return on equities, and apply that to all businesses. So we're making apples to apples comparison across businesses. And in addition to the discounted cash flow, we supplement that with traditional and objective, valuation metrics like price earnings and price to book and dividend yield, that sort of thing.
James, you've had a great track record, and for clients and investors looking to own real businesses, just like Warren Buffett would sort of espouse, this has been a fantastic place to be. Can you talk to us about how you view dislocation and what your opportunity set is in troubled markets, perhaps, harking back to a year ago in March?
Yes, the funds thrive on volatility. If we went back to 2017, for example, the S&P 500 index went up every month on the course of 2017. It had never done that before in history. That was a frustrating period because there wasn't volatility. So I try to take advantage of volatility to embrace it. As Buffett says, volatility is the friend of the long-term investor. In the dislocation that occurred in 2020, I will say I didn't take the leverage up as high as I might have in prior downturns, because this was a one-in-a-century pandemic and there was real economic damage. And I wanted to make sure, to be positive that we would see through to the other side of this in terms of the fund's performance. And I'm pleased to say that we did by the fall, and that carried on to stronger heights since then.
Did you make any adjustments in terms of your individual companies in the portfolio, whether it was new companies, getting rid of any, and or adding without leverage?
Yeah, well, with good luck or good management, we didn't have anything that I would call in the epicenter of the crisis. So we know I had no travel stocks or, casinos, airlines, hotels, anything like that. Nothing energy related. Oil went to a negative price there briefly in April of 2020. We've been bolstering our investment team at Portland over the years. We did have a new gentleman join us with great international experience. And so it was because of that, more than the dislocation, that the funds have become much more international, which is great because it's really broadened out both the industry sectors and the geographies from which we're selecting.
Mm-hmm. Great, thanks.
So in terms of having a very concentrated portfolio, how do you get conviction on holding 10 companies in a portfolio? Because some might think, well, you could be really whipsawed by that, by only having such a small number of companies. But how has it worked for you, and how do you get to that level of conviction?
Well, the focused portfolio allows us to do a very deep dive on individual businesses. As I realize every portfolio manager says that, but we can actually do that, because we own so few businesses. And in fact, that's the way the world's wealthiest people got to be that way, is owning a small number of businesses in large percentage weights. So that's limited number of companies permit that. And if we're not comfortable for any reason, be it the industry or the management quality or the leverage in that business, then we just don't invest in it at all. I think if you have 50 stocks, as you often see in other portfolios, you've got little firecrackers going off all the time of damage, to that portfolio performance from things going wrong in those businesses. Whereas we really concentrate and then watch that basket extremely carefully.
You touched earlier on your discounted cash flow model and rates being as low as they are, and I think you've done the right thing by sort of using an 8% interest rate. What happens in your world, and do you change your process, and or does your stock selection become adjusted, or your cash flow model, I suppose, when rates start to rise?
I'm fully prepared for rates to rise. We've seen a little bit of that already, and interest rates are up off their lows. And normally, rates can go up for a while in a recovery period without it impacting equities, because it's a sign that the economy is strong. Right. And if those higher rates, get to a point where they start to cause dislocation in equities, then, I hope to take advantage of that, as we have in the prior times of volatility. And, we are at such low rates that I think equities will remain the best performing asset class for a considerable period of time.
Mm-hmm. Great.
Unfortunately, our time is up. I'm sorry to say. But before we wrap up with you, James, I'd like to ask Loren and Craig a question. Loren, how would you use the Portland Focus Plus fund in a portfolio? To what type of client would you recommend this fund?
I think this is for a client who is looking for, those long-term returns. So they need to be a long-term investor, long-term mindset, but are looking for that additional alpha that you can get from a more concentrated portfolio, but be willing to withstand maybe some more ups and downs given it's concentrated, but be invested for the long term.
Great.
Yep, I would agree with that. I think leverage can certainly work in your favor so long as you have that longer term view and you're not going to react during tough times. We often ask clients, in a 20, 30%, 40% drawdown, would you panic or would you add to this? And if they're going to add to it, then, we like to add to something like James's fund for that type of client.
Got it.
And the last thing I'll say is, it's nice to own real businesses, right? Like when things get ugly, you've got a real business behind it that isn't potentially going to zero, which is where James' time is focused.
That's great. Well, thank you, James, very much for participating again this year in the Winners Showcase. We sincerely appreciate your time. Next up this afternoon is Paul Sanju, President and CEO of Merit Asset Management. Paul has over 30 years of domestic and international fixed income experience. Prior to joining Merit in 2009, Paul was responsible for the global distribution of Canadian fixed income and money market products at BMO Capital Markets. Through offices in Toronto, Montreal, Vancouver, New York, London, and Hong Kong, Paul was directly responsible for advising some of the world's largest fixed income asset managers on portfolio strategy, asset mix, security selection, and alpha beta generation. Paul's career also includes positions with Goldman Sachs and Citibank, the US, and Canada. Paul holds a BA in Economics and Political Science from the University of British Columbia and a Master's of Public Administration from the University of Victoria. 3 Merit hedge funds won a total of 5 awards at the 2020 Canadian Hedge Fund Awards. Paul, I want to thank you so much for joining us today. I look forward to your presentation, and I turn it over to you.
Julie, thank you for that introduction, and thank you everyone for joining us. For those of you who don't know Merit, Merit was established in 2001, and we currently have just a little bit over $5 billion in assets under management in a variety of different types of strategies, including core bond funds, hedge funds, and liquid alternative funds. We exclusively focus on fixed income strategies, and we specialize in corporate credit. Today, I wanted to take a couple of minutes just to introduce you to the Merit Diversified Opportunities Fund, a fund that we sometimes refer to as MDO. So MDO is an unconstrained bond fund focused on total return. It's a mandate that we've managed for 3 years. We've managed hedge funds since the firm originated back in 2001, so we're not unfamiliar with hedge funds at all. But we've managed this particular mandate for about 3 years. And in 1920, it was the recipient of the best one-year return in the Canadian Hedge Fund Awards. MDO is basically really a compilation of our other hedge fund strategies. In fact, about 85% of the fund is composed of the most high conviction trades in our other hedge funds. These other hedge funds focus on short duration credit, investment grade credit, high yield credit, and outright duration in government bonds. These funds have won multiple hedge fund awards over the years for both return and Sharpe ratio. So basically what we've done is taken the success of all of our other hedge funds and housed them essentially in one strategy. The other 15% of the fund is composed of ideas that are generated by our PM and research teams, and those ideas can include exposure to equities, commodities, currencies, and inflation-linked types of securities. A single trade in MDO typically represents about 50 to 100 basis points of exposure, so that ensures that the mandate is always very diversified. It has very low volatility, and typically has negative correlation to risk assets. It's an actively traded mandate, so it focuses on generating alpha from multiple areas of fixed income. And it is based on taking that exposure as we determine where we are in the economic cycle, the credit cycle, and the interest rate cycle, as well as, and most importantly, valuations in the different asset classes that we actually trade. I am sure that Mark Culver, who's the president of our private wealth business, and our marketing team would be happy to take you through the strategy in greater detail. Of course, I'm always happy to hop on, as are any of the PMs, to give you, sort of further clarity on the strategy. But that's just a bit of the highlights. And I'm happy, after giving you that little brief introduction, perhaps moving into questions, which will give you maybe a little bit further idea of how we run the strategy and why it has performed so well over the number of years we have managed it.
Thank you so much, Paul. That was interesting. And yes, let's move into questions. I'm going to invite Loren and Craig, and here they come back onto the screen with me. And we'll move into our investors inquiry segment today. Loren, perhaps you wouldn't mind kicking off with the first question?
Great. Hi, Paul. March 2020, this year, Q1 was a very challenging environment for bond strategies, particularly credit alternatives. Can you talk about how you managed through what was the first sort of manage through that process when we hit those markets, and then coming out of it, the opportunities you saw?
Well, the most important thing for us, and I think I referenced this at the end of my presentation, is really understanding valuations and risk reward in the asset class that we're managing. 2020, in March 2020, wasn't a problem for almost all of our mandates, and particularly this one, because we had paid attention very critically to valuations. We had in this strategy virtually no exposure to credit. And the reason that we didn't have any exposure to credit is that we thought at the beginning of 2020 that corporate credit, high yield credit, from a valuation perspective, didn't make any sense. The risk reward in credit was extremely low. Credit spreads were at their tightest in almost history. Corporate leverage is almost its highest in history. So you were getting paid very little to buy something that was incredibly risky. So when we see valuations and risk reward like that, our general tendency is to say, hey, we don't want to have a lot of exposure or any exposure to that. So when March 2020 came, we didn't have to worry about how our credit portfolio was performing in this fund because it essentially didn't have any credit in it. We had sold all the credit because, again, of valuations. And by the way, it was clearly a lot had to do with valuations, but a lot also had to do with how we look at markets. And we felt that as we entered 2020, not only was the risk reward and credit poor, but that we were nearing the end of a very long economic cycle. At the end of toward the end of the cycle, you don't take more risk, you take less risk. That's certainly our experience. And finally, we also we kind of disagreed with the consensus view in the market that 2020 was going to be this outsized year for economic growth. Our analysis certainly didn't tell us that. So all of those three things, valuations, end of the cycle, and really the outlook from a macroeconomic perspective, told us, hey, don't take any exposure in credit or take very nominal exposure in credit and actually have a really high quality exposure. This mandate was almost totally exposed to government bonds at the beginning of 2020. And I think, as everybody will now remember, government bond yields or central banks essentially cut rates to zero. So this bond benefited from having high quality exposure to duration during that time. And so we navigated it quite well. And I think, as you might see, I'm not sure if the slides are still up, but we had positive performance in the first quarter of 2020, I think, relative to almost every other hedge fund around.
Right. Given some of the recent trading that we've seen in the market with the retail investor interest coming on board and trading on their own, and seeing some things that happened, such as investor behavior with GameStop and others, does that provide you with any concern on a go-forward basis to, how you manage your fund and what you sort of see, moving forward?
Yeah, it does in some respects, and I'll reflect on that in a second. But one of the things that is important to remember in what we're doing is we are trading fixed income, and fixed income is an over-the-counter market. It's not broadly an exchange-traded market, right? So, these folks that were involved in, whether you want Reddit or Robinhood or whatever you want to call it, all of that activity in the markets a few weeks ago were essentially, focused on exchange-traded funds where they could actually understand and see what the positioning of different people was, right? So, if you recognize, hey, half the world is short something, and you want to start to, take a run at that, I guess it's pretty easy because you have that visibility. In bonds, it's harder to have that visibility because our products in general are, traded over the counter. So there's certainly there's less risk. I mean, in some parts of fixed income, you do have more clarity. For instance, the government futures market would certainly have, would have more clarity in terms of positioning. But broadly, the over-the-counter market kind of protects us from that. But I will say to you that, given what we did see happening in markets, we did we are more cognizant of our short positions and the size of our short positions and the liquidity that those short positions actually have. So it just definitely has changed our thinking a modest amount, but our overall product that we trade and where we generate alpha has less visibility and has less exposure to that kind of activity.
Thank you.
Thanks, Paul. Can I ask you a couple questions? You touched on the notion of corporations being, was it flush with cash? Was it a whole lot of cash that you talked about earlier? And you mentioned something. Let me come into my question. The view forward, this is what I'm trying to drive at. The view forward from here, we may see, we're at some point going to see rates rising. How does that affect your approach to all this? And perhaps I'll think of my question, I'll come back to you.
Yeah, well, no, you're right. I mean, we're at a stage from an interest rate perspective where interest rates are generally low. Everybody's fearful of much higher interest rates, and that obviously is never a good thing for most bond portfolios. Credit spreads, as I've referenced and you've referenced, that are quite tight again. We've had a dramatic movement in credit spreads over the last, since last March. So where's the opportunity? That's why we really like this Merit Diversified Opportunities Fund strategy, because it's flexible and has a lot of optionality. We are not tied to any one particular asset class in fixed income. This is not a fund that's just tied to generating alpha from credit. I mean, we talked about that earlier. If we were 100% government bonds, going into March of last year. So what the focus for us is to say, where do we think the best risk-adjusted return in fixed income is? And fixed income is composed of a lot of different things, right? I mean, there's government bonds, there's inflation-linked bonds, there's investment-grade bonds, there's short-duration bonds, there's high-yield bonds, there's floating-rate bonds. So what we're really focused on is saying, hey, where are we in the economic cycle? Where are we in the credit cycle? Where are we in the interest rate cycle, right? Based on those things, right? Different parts of fixed income, those different products I just talked about, will have different types of risk-reward. And so this strategy is flexible enough to go to where we think the best risk reward is and where we can generate the most alpha. So it's that flexibility and optionality that doesn't tie us to one segment of fixed income is what I think really helps us in this strategy, given where we are in the interest rate cycle and given where, credit spreads are at this very time.
Nice to have looser parameters, isn't it? Can I ask one more question as well? Does leverage play a part in your fund and your strategy?
Well, the fund can use leverage, but I think the entire 3 years that we have managed it, we've never actually utilized any leverage. And that's kind of part of the Merit DNA. I mean, there's two things that are really important to our DNA. One is understanding valuations and being very disciplined about saying, hey, if the asset class has bad valuations, why are we invested in it? It doesn't make any sense. And the other is basically the use of leverage. We tend to be very conservative in our use of leverage. And again, we're not focused on saying, hey, let's try to get returns out of leverage. What we focus on is, hey, in fixed income, where do we think the best risk reward is across that fixed income spectrum? Let's just go there. So often it's just about being in the right part of fixed income. It's not about leveraging the asset class. Like early in the cycle, if you think about the economic cycle, early in the cycle, you probably want to be in high yield bonds. Typically, high yield bonds after a recession have really widened out, and you want to have exposure to high yield because an improving economy will benefit high yield spreads. You don't need to leverage high yield to get a really good return during that part of the cycle. You just have to recognize that that's where the best place to be is.
Great.
Paul, thank you. And I'm sorry, unfortunately, our time with you is almost up. But by way of wrap up, I'd like to ask Loren and Craig the same question that I have been asking you this afternoon. To which type of client would you recommend the Merit Diversified Opportunities Fund, and how would you use the fund in a client's portfolio?
Well, I think clients who are looking for that additional alpha out of fixed income, trying to find that, which is very difficult today, given where interest rates are. This is an interesting strategy, certainly, to achieve some very good returns for the fixed income part of a portfolio.
I agree with that, and important for investors in bonds to recognize that it's a tough game to play, right? We are at the bottom of a cycle here in terms of rates. It could be a losing proposition in terms of taxes, fees, inflation, and everything else. So replacing some of these buy and hold bond strategies with what Paul and his team are doing, to Laurent's point, are going to give you some more upside and reduce your volatility potentially along the way as well.
Great. Well, thank you all. Paul, we've really been delighted to have you join us and participate in this year's Winners Showcase event. Thank you so much. And look forward to next year.
Yeah, it's been a pleasure to be here, and thanks for having us.
Thank you.
Thank you.
Our next presenter this afternoon is Sandy Liang, Lead Portfolio Manager, Fixed Income at Purpose Investments. Sandy has 30 years of credit and investment management experience. His fund was a winner among credit-focused funds for Best One-Year Return at the 2018 Canadian Hedge Fund Awards, for Best 5-Year Return at the 2019 Canadian Hedge Fund Awards, and for Best 3-Year Return at the 2020 CHFAs. Mr. Liang has 13 years of experience on Wall Street, leading fixed income for Cobalt Capital Management and as Senior Managing Director at Bear Stearns in New York City. While at Bear Stearns, Sandy was named All-American Fixed Income Research Team for High Yield by Institutional Investor magazine for 7 consecutive years. Sandy has a BA from the University of Western Ontario, an MBA from McGill University, and has the CFA designation. Sandy, thank you so much for being with us today. We really appreciate your time, and I'm going to turn it over to you and look forward to your presentation. Thank you.
Thank you. Thank you, Julie, for the opportunity to present at the Canadian Hedge Fund Award Winner Showcase 2021. I have a presentation, so you can just follow along. First page is, as you referenced my background, Julie, I think that what is most unique about my background as a fixed income manager is that I have spent most of my career understanding companies and being an analyst. So the first 2/3 of my career, I was a sell-side analyst, both in credit and equities, and really dug deep. So we did an exercise where we looked at the number of companies that I've met in my career, and it's well over 1,000. And so this is unique as a fixed income manager where I didn't start on the trading desk. And as you referenced, I spent the formative years of my career understanding companies from the sell side, and I went to the buy side after the credit crisis, and I worked for a billionaire hedge fund manager, Wayne Cooperman, who was hedge fund manager in New York at Cobalt Capital, and was really formative in forming our investment philosophy on the buy side here at Purpose. So the Purpose team of analysts, an industry specialist model, and each analyst is very experienced in their own right. Lots of bench strength there. So the table illustrates how we look at the world, where we start from the leverage capital structured universe, roughly 3,000 companies, and through that we go through a funnel and we end up having a portfolio of 50 to 70 positions. And what's really important for us is that we know the whole capital structure in a company, the secured debt, the unsecured debt, preferred equity, or some common equity, and we also take a very close look at asset value protection, because when you're managing credit, really the idea is that you put out your principal and you get your coupon along the way and you principal back at the end. So asset value protection is very important. And we also think a lot about liquidity, not just in terms of corporate liquidity and cash in hand and revolver availability, but the trading liquidity and the securities we're involved in, because everything we're in trades every day. We generally trade with established market makers. The next page shows the performance history of the Credit Opportunities Fund. We started the I-Class in 2013, and we opened up the fund to outside investors in 2014. And through this period, we've been through actually 3 difficult periods in the corporate credit market. In 2015 was a difficult year for high yield, and you can see that the passive strategy was down 5%, whereas we had a positive return in 2015. 2018 was another difficult period for the corporate credit market. We had a positive return, and it's pretty clear or pretty fresh in everyone's mind what happened in 2020. And through the first quarter of 2020, I can't say the positive returns, but we didn't lose nearly as much as equity or passive credit, and we ended up having a very positive year in 2020 as well. So a solid 7-year track record, roughly 10% return since inception. That's fully loaded with fees, of course, and our upside downside capture has been 1.35 times the upside of a high yield passive strategy and 0.65 of the downside. So our upside downside capture is very strong. Now this is a busy chart, but what's really important here is that the one takeaway is that we're not levered. We don't borrow money to achieve our returns. And in fact, we've had a fairly high cash balance through the history of the fund, and that would be the brown line that shows cash. We had a high cash balance going into the great lockdown last year, and really our cash balance is not determined by our view on the market, but it's sort of idea flow. We have more investment ideas, then we put more money to work. And the other thing that's important about this chart is that it shows that we have a high cash balance, and that's very strategic for us because when you're dealing with high yield credit, really you never ever want to be in a position when you're having to sell when you don't want to, and you really want to be in a position where you're buying when everyone has to sell. So in terms of thinking right now, near-term opportunities, we have what's called dislocation playbook. As you recall, I was on the buy side in 2008, 2009, and that was a very formative period in terms of learning about dislocation. And in a period of dislocation, really, you want to see what markets have been harmed technically, where players don't want to, they sell what they can get a bid for, and often don't have a choice, especially if they're leveraged. So one of the areas where we exercised a dislocation playbook in 2020 is in the area of mortgage REITs. Mortgage REITs is a whole industry in the States, and what they do are companies that are portfolios of mortgages, and the mortgages themselves are on commercial properties or residential properties, and there's always a property owner that has skin in the game. But on top of that, the mortgage REITs as companies themselves also have equity. So when you're lending to a mortgage REIT, you have 2 layers of equity protection. And this is a pretty significant area in our book right now. It's at one point it was 20%, now it's roughly 17% of our book. And what the chart shows is that where we are in mortgage REIT A, B, and C, we have roughly 50% loan to value to the underlying real estate, and we're making 9% return, whereas in the commercial mortgage-backed securities market, which is a direct comp, the same securities are only making roughly 4% yield. So we still think there's an opportunity there, not just in terms of relative value, but in terms of total return as well. Another area that we're focused on right now is SPACs. We're not investors in SPACs, but we feel that SPACs are a real tailwind for the high yield market in 2021. And a SPAC is a special purpose acquisition corporation. The company is formed just to make acquisitions. And to make a long story short, the Fed has been very accommodative. Global central banks have been very accommodative. And what that means is that there's a lot of unintended consequences in terms of the asset classes that benefit. And so, SPACs are really a byproduct of all the free money around from the Fed. And what they're doing is they're going and buying a lot of private companies. So given that the high market is full of private companies, really, if you're a lender to the high yield market, you're a beneficiary because there's a lot of equity capital around. So there's been a couple of cases already where we've had winners from SPACs, but we have one where the name of the company is Curo Group Holdings, and their subsidiary is being acquired by a SPAC this year, and that's been announced. So the day after announcement, the bonds that we held were up 10%. The company's common equity was up 89%, and really it's because the equity capital has made its way into Curo by buying its subsidiary. So as a result, Curo's leverage is now lower, its asset coverage much higher, And it's been a very good story for the capital structure as a whole, and we believe that this is going to be repeated in other companies through 2021. So with that, I'll stop there and we'll pause for questions.
Thank you so much for that, Sandy. That was a very interesting presentation. I think I speak for everyone when I say we really appreciated that. And I'd like to ask Loren and Craig to join us because we'll now move into the investor inquiry portion of our segment with you. And Craig, if you don't mind, maybe I could ask you to lead off the questions.
Yeah, happy to do so, Julie. Thanks. Hi, Sandy. Thanks for all that. First question, when we're talking about the fixed income world and the credit world, and seemingly we've been asking this question since we came out of the financial crisis in 2008. Interest rates at some point will rise, we anticipate. How does that affect your world and what you're doing in the fund?
Sure. First of all, the engine of our alpha over time is in the high yield debt market. And in the history of the high yield debt market, actually, when rates are going up, the returns have been when rates are going the other way. And that's been in the history of the market. And really, it's because there's a lot of credit spread in the high yield market. However, what's happened in the last 12 months is that the high yield market overall has gotten a little bit more interest sensitive because there's a lot more double B paper, high quality, low yield. So it's made the overall market a little more interest sensitive. However, the things that we traffic in, will we create alpha, lending to companies with a high yield, that hasn't really changed. Where a lot of what we do is, if you're lending to a company for 2022, 2023, 2024, and so on, it's not really as interest sensitive as you might think. In fact, it has very little correlation with anything if you get your money back. But the other thing we're doing in the fund, because it's a liquid alternative hedge fund, we have the ability to short, and we think there's an asymmetric opportunity in shorting investment grade corporate debt that's negative yields right now. And against that, we're going long some inflation protected securities. So we believe that's another layer of protection against higher rates built in.
Okay, good to know. Thanks for that. I was interested in your approach to the mortgage REITs. That sounds like an interesting trade. Tell me, what's the risk of that trade? Is it economic sensitive? Is it housing sensitive? Employment sensitive? What does that mean?
I would say that it's a dislocation trade because almost all the debt that we're in matures in 2022 and 2023. And for our key positions, so it's pretty short term. Those companies have already raised liquidity from other sources to take care of their maturities. So, I believe that it's still a dislocation trade where the opportunity it's just slowly kind of it's being bridged every month, where the opportunity originated last spring, and every month it seems to get a little bit better. There's more of a recognition that there's a dislocation. But how can we get hurt here? I mean, if we get hurt in our 2022, 2023 paper that has 50% loan to value in commercial and residential real estate, if we get hurt here, then the world has much bigger problems than our paper.
Yeah, that makes sense. Thanks for that.
Great. Well, Sandy, there's lots.
Go ahead, Loren.
There's lots of different credit opportunity funds out there that are available, and maybe you could just elaborate a little bit about what sets you apart from the other ones, and so why choose your credit opportunity fund versus others that might be out there.
Sure, of course. Well, first of all, since I've been back in Canada the last 10 years or so, what I've found is that there's three broad categories of credit funds. There's people that do which is high yield credit research. There's a lot of leverage and invest corporate debt funds that have their own kind of systematic risk. And then there's private debt funds, which really do similar things to what we do. However, if you want to get your money back, you have to wait. And so in terms of those categories, I feel that 2020 was where we really learned the drawbacks of the other kinds of credit funds. So I feel that, being in a credit risk fund where the stuff we do trades every day is really an advantage. But what I'll say about you and our real competitive advantage at the end of the day is our secret sauce is investing. And when I say investing, I mean it's quaint these days talk about things like due diligence and meeting with management teams. And, we can't really tour facilities right now, but we think of every industry in terms of supply and demand for whatever it is. And, we go through a process where at the end of the, we really, for each investment, the idea is to get to the finish line. And that finish line means having a thesis where the risk reward is in your favor, makes sense and is well founded. And if you can repeat that process with every analyst, every idea, and make a portfolio of things that you want to own, and proud to own, then you'll end up having a portfolio that will have a superior risk reward over time. So that's what we do. I have a lot of experience doing this, as you know, and I trained, I think, under a very good investor when I was in New York after the credit crisis. That really is our advantage. It's old-fashioned, but it's investment sense in doing the work.
Great.
Thank you, Sandy, very much. I'm sorry we're out of time because it's a very interesting product. I want to ask Craig and Loren a couple of questions. To what sort of client would you recommend the Purpose Credit Opportunities Fund, and how would you tend to use the fund in your clients' portfolios?
Yeah, I think there's two types of clients here. One would be a buy and hold bond investor. I think it's pretty clear to all of us that's a losing proposition after taxes and inflation. So to have somebody like Sandy and his team with their experience actively managing a diverse and multi-pronged sort of approach where they can go just about anywhere, that's simply going to add more upside, and ultimately even reduce some volatility and protect some capital if we do see a sudden spike in rates. So that's the first client. And then the second one would be, excuse me, somebody who simply wants a bit more volatility across the portfolio as a whole without giving up the chance of returns. I think this would serve a nice little slice in that defensive bucket.
Yeah, and I would agree with Craig's analogy as well. I think, it makes sense for those investors who are looking for something that's a little different, that can add some incremental return up and beyond what the fixed income market is certainly offering us today.
Well, thank you so much, all of you, for that. Sandy, it's such a pleasure to have you join the Winter Showcase Investor Conference this year. We really appreciate you participating. Loren and Craig, thanks again for your insightful questions. It makes such a difference and really gives us all an opportunity to look under the hood of this fund. So thank you. Our final presenter this afternoon is Jim McGovern, Managing Director and CEO of Arrow Capital Management. Jim founded Arrow Capital in 1999, bringing over 30 years of related experience. Previously, he had been president and CEO of BPI Financial Corporation, a publicly traded company that he co-founded 13 years prior, and which managed or administered over $6 billion in assets. Jim is a founding and past chairman of the Canadian National Group of the Alternative Investment Management Association. He graduated from the University of Toronto with a Bachelor of Commerce and Finance degree. Jim is active in charitable organizations, including Hedge Funds Care Canada and the University Health Network. The Arrow Global Advantage Fund was a winner for Best 5-Year Return in the Global Macro category at the 2020 Canadian Hedge Fund Awards. We are delighted to have you with us this afternoon, Jim. Thank you so much. I'm now going to turn it over to you.
Thanks very much, Julie. So the Global Advantage Alternative Class Fund, as you mentioned, is a macro-focused alternative investment fund that's a little over 5 years old now. The fund itself is managed by myself, along with two colleagues, Austin Mirza, who's a hedge fund veteran analyst who joined us in 2016, and Lynn Wang, who's an associate portfolio manager and handles a lot of our international investments. The fund is really designed to generate capital appreciation across all the different principal asset classes, which include debt, equity, commodities, and foreign exchange. We're trying to target a 6 to 8% return per annum consistently, with generally low correlation to equities and to bonds, and also low volatility. We try to minimize drawdowns, in particular, by managing our gross and net exposures quite actively. The fund is really split into two pieces. One is a pure global macro type fund, which is actively traded, long, short, not benchmark constrained, and really has a cyclical model underneath it, with which we use to express those views. And then we have another piece, our global long, short equity portfolio, which also is predicated on those key macro trades, but we express it via individual securities. So we take a very solid approach, we think, to managing risk. Fund generally has low to moderate concentration, low leverage, very liquid. We're respectful of markets, and we always have tail hedges in place for really out of the blue type situations. The process, as I said, is really focused on getting the cycle right. So where we differ from others is that we're looking at changes on the margin in GDP growth, which is the driver of corporate profits and so on, and changes in headline inflation, which is the principal input to figuring out your discount rates on how to value assets and so on. So if you think about it, when you're looking at inflation and GDP growth, you can have either both going up together, down together, or moving different ways. So 4 sort of different scenarios from which to choose from. Each of those scenarios demands, from a roadmap sort of perspective, different asset allocation, sector allocation, and so on. And we basically follow this process in terms of setting those allocations. So once we have our view, which is determined by looking on forecasting rather only 1 to 2 quarters in advance. So these are shorter term forecasts that also have a higher degree of probability of being right. Once we've set that forecast, we then allocate to the various sectors and asset classes. And then finally, we populate the portfolio from a bottom-up perspective. So we have analysts and research boutiques that help us with security selection as well. So as I mentioned, these 4 possibilities for changes in GDP and changes in inflation, you can see produce 4 different types of economic scenarios. Most of the time, we're in a positive GDP growth period, and so either it's inflationary growth or real growth. But from time to time, inflation can rear its head, as it's doing now, and can create different types of other types of situations economically. For us, the part of the cycle that's the most dangerous for long-only type mandates would be a deflation, disinflation type market, where the delta on GDP and the delta on inflation are both inflecting down. We actually sort of see that as a likely scenario for later this year. In terms of the portfolio construction, at a position level, we build these positions over time, but as you'll see on this slide, individual equity positions are typically 25 to 50 basis points. So this is a highly diversified fund. And that is in keeping with the idea that we really want our macro top-down views and positioning to generate the returns. And we're looking for more diversification in the securities names to express those views. Individual position sizes are obviously monitored, but at a portfolio level, and importantly at a portfolio level, we maintain strict limits on gross exposure, net exposures. We have daily reviews in terms of portfolio volatility and correlation, just to make sure that the portfolio is positioned as we think it should be. The fund itself has generated some good returns over time, but really in terms of our benchmarking ourselves or reviewing ourselves, we're trying to find, again, a consistent annual return, much lower volatility than the equity market, reasonably high degrees of or high levels of alpha. And to do that, obviously, our correlation to stocks has to be low, and the drawdowns have to be low. And those are really the key features of this fund. So the folks that benefit from this kind of mandate, it's a very flexible mandate with a very disciplined investment process. Typically, we find people interested in this product are looking to reduce portfolio volatility overall. They're also looking to add something that has relatively low correlation with other assets or strategies that they have. And they're looking for something that adds alpha, so it's generating positive returns over time. We do think there's a strong alignment of interest in this fund. I'm one of the largest investors in the fund. We do have capacity limits, although we're not near them at 100 million in assets right now. And we've set up a structure so that any performance fees generated have to come after we reached a hurdle rate of 5%, which is not too far from where our average bogey is in terms of annual returns. So with that, I'll turn it back over to you, Julie.
Thanks so much, Jim. That was really interesting, and I'm anxious to bring Craig and Loren back on screen and turn it over to them for the investors' inquiry portion of this session.
Great. Thanks, Jim.
Hi, Craig. Hi, Loren.
Hi, Julie.
Hey, guys.
Thank you, Jim. First off, it's a real pleasure to read your. I think it's Monday morning. You send out your macro view based on the fund. It's a nice email to have each Monday morning. So thanks for that. First question. This is a macro fund. Historically, macro funds have typically been able to garner some significant returns through the years. They also haven't been without volatility along the way, and at times sort of correlating to one, if you will. When everything falls, oftentimes, or at times, macro funds can have a really tough go. You've proven this to be a very different strategy. If you can just sort of perhaps highlight the key drivers to what has held up the fund, what has really set a foundation in place through your experience, and then second of all, tying into that, what sort of volatility works for you? Volatility can provide opportunity. What type of volatility works for you?
Sure. Okay. Let me just take your first question, Craig. So the way we've been able to protect the portfolios, as I mentioned, we have generally it's a cyclical model. So there are times in the cycle where you really have to be careful, where in fact the correlations, as you say, do all kind of go to 1 or -1. And we typically find that, in these periods where inflation is falling quickly and GDP is as well, it's sort of a very bad period for stocks and a very good period for government bonds, for example. So when we're doing our forecasting, if we see that as a decent probability for a scenario going forward, we'll reposition the portfolio into a much more defensive posture going into that. So we're happy to sacrifice returns when you look at that versus what the potential drawdown would be in the wrong type of scenario. The other thing that we're active in is tail hedging.
Right.
So you never know when something could come out of the blue, like a nuclear explosion or a war, or China invades Taiwan, who knows? Yeah, any of those sorts of things. So we typically have on different trades to try and protect against that. So for example, today we have deep out of the money puts on Aussie yen pair. Because when you do get these kind of heavy risk off type moves, you can make a lot of money. So on that put, but it'll only kick in on a deep fall. So the idea here is we're happy to take on some day-to-day or week-to-week mark-to-market changes, but we do want to protect the portfolio against a really sudden drawdown.
Mm-hmm. Okay. And again, just a quick comment, perhaps, not all volatility is created equal. So is there a preference in volatility for you?
Well, volatility really comes in two forms. One, it's, episodic, like what we have going on right now, where it's trending. When volatility is trending down, it's one of the great things, right, for long-only investors in particular. and leveraged investors. Falling volatility allows people to put on more exposure, and it's almost like a self-fulfilling prophecy on the way up. Trending down is obviously not so good for equity. Trending up rather is not so good for equity investors. Our view is if you have volatility right now that's sort of range bound, and let's say we're talking about the S&P 500, somewhere between 20 and 30 on the levels, you can make very good money trading volatility and trading, and that would include either trading volatility outright itself and sort of VIX futures, could be in trading spreads around indexes, all kinds of different things, or even just trading around your core positions as they move. When it goes below 20 and is trending down, that's just generally not so good for alternative funds. We struggle because some of the trading profits that we could have collected just aren't present. And obviously we had a tough period leading up to, say, the financial crisis, when volatility, say, on equities fell below 10. We don't think that's going to happen again. We think we're in a world that where macro is more and more important, and so we don't really foresee volatility going much below 15 ever again, or at least not for the next 10 years or so.
Okay, great.
Great. Jim, you talked a little bit about, different cyclical periods or deflation or disinflation versus inflation. Can you talk a little bit about, in a scenario where we have, say, low interest rates going forward, low inflation versus interest rates starting to rise and starting to see inflation, how you might differ, do different things in the portfolio?
Sure. So we would call those sorts of episodes phase transitions. So that would be where you're going from one economic environment, say real growth, into another environment, which is stagflationary scenario where you've got growth falling but inflation rising. So again, we're looking always 1 to 2 quarters forward. We just simply use year-over-year change in data. We use a high frequency nowcast model, and we're trying to predict where we're going in the economy. Our batting average around 75%. And so, for example, not to time date this presentation, but this summer, so starting in the third quarter of this year, we're projecting inflation to roll over, and which is now trending higher. Our inflation number for Q2 is much higher than the streets right now. But for Q3, we see inflation starting to roll over and GDP rolling over. So this is the scenario that makes us nervous in securities markets, and we'll start positioning for that probably in April or May of this year.
I hate to interrupt. I really do. And I can't believe that our time is up already, to be honest. But just before we wrap up, I want to ask Loren and Craig very quickly, to which type of client would you recommend the Arrow Global Advantage Alternative Class, and how would you use it in your clients' portfolios?
From my standpoint, I think this is a great example of adding diversity to a portfolio. It's been said 1,000 times that diversity is the only free lunch in investing. And Jim and his team have created a unique, really interested, non-correlated, non-hitched to any sort of market return stream. And so, to add that in terms of our world, we will put that into what we refer to as the defensive bucket. We're not big believers in owning bonds. This isn't a bond replacement, but it is a volatility replacement. And that's what we would section it into the defensive piece.
Yeah, and I would agree with your comments, Craig. And I think too, it's for the investor who is really looking for something that has a lower volatility and some sense of predictability. If you're focusing on that 6 to 8% return, I think that again, for long-term investor, but the macro approach can really work.
Great. Thank you, Jim, so much for being with us today and participating in this year's Winter Showcase event. We really appreciate it. It's been great to hear from you and about this particular Arrow fund.
Thanks, everybody. Really appreciate it.
Thank you.
Loren and Craig, appreciate your time and your good questions. It really makes a difference in helping all of us get a better understanding of these funds. So thank you. That completes the CHFA Winners Showcase 2021 virtual conference. Thank you for joining us. I hope and trust that you found the presentations and the discussions this afternoon were enlightening and useful. I certainly did myself, so I hope you did too. On behalf of Alternative IQ, I want to thank our 5 award-winning hedge fund managers for sharing their insights so candidly and so generously today. It was a very special opportunity to get to know them and their funds much better. And a special shout out to Loren Francis and Craig Michelle, our Investors Inquiry panelists. They really spend a lot of time preparing for this event, and it's their insightful questions that make such a difference and help us get to know these funds better and how their performance can improve our investment portfolios. We're very grateful to our sponsors, and I want to thank Brooke Biscoe at Fundata, Peter Goulas at National Bank Independent Network, Helen Billette at Newsfile, and Dan Dornbush at Scotiabank for making this event possible. Thank you again, everyone, for joining us today. I look forward to seeing you next year and hopefully in person.
Hi, I'm Reid Baker, Vice President of Analytics and Data at Fundata, and I'm going to give you an overview of Fundata's Canadian Alternative Investment Fund risk ratings. The Fundata risk ratings are based on 4 risk measures that met the criteria for wide market acceptance and breadth of data: maximum drawdown, standard deviation, up-down capture, and batting average. For each of the metrics, scores are assigned for 1, 3, 5, and 10-year periods. Then we take the average score across the time periods to arrive at a final score from 1 to 5. We also add a liquidity score that was developed in partnership with Sigma Sandbox. To be consistent with regulatory requirements for retail funds, we use 10 years of performance history for each fund. Funds that don't have 10 years of history are supplemented with proxy index data based on the investment strategy of the fund and how it fits into one of 6 categories. Let's look at the detail of how each metric is calculated. Maximum drawdown measures a fund's peak to trough loss over a specified period. We calculate the max drawdown for each fund and assign scores based on how it compares to the drawdowns of the 6 hedge fund indices. Standard deviation is a widely accepted measure of volatility risk. It's calculated over each period using monthly returns and then slotted into one of 5 volatility bands. These are the same volatility bands that are used for calculating the FundFacts risk ratings for mutual funds and ETFs. Up and down capture measure how well a fund did when the market was up and down respectively. Up capture greater than 1 represents outperformance, and down capture greater than 1 represents underperformance. This is an illustrative grid showing the universe of funds over a 5-year period, where the black lines represent the medians. Scores are given dependent on which quadrant the fund falls into, as seen in this table. The scores from 1 to 4 are converted to a 5-point scale. Batting average measures how often a fund produces a positive monthly return. Scores are given according to how the batting average fits into one of 4 quartiles. The scores from 1 to 4 are then converted to a 5-point scale. Finally, the liquidity score considers 5 liquidity measures related to how a fund can be bought and sold: redemption frequency, redemption notice, early redemption cost, suspension, and gating. For each measure, funds are given a score from 1 to 5, where 1 represents higher liquidity. The 5 metrics are combined using a weighted average based on relevance. The results are converted to a liquidity score from 0 to 1. The final risk rating is determined by taking the average score from the 4 risk measures and adding the liquidity score. The highest score a fund can get is 5. For more information, please visit our website or reach out to one of our team members.